Hello, and welcome to episode 21
of Money,
the Investing Show for Millennials by a Millennial, where our goal is to educate, entertain, and empower a new generation of investors. I am, of course, the host with the most gorgeous face and brown eyes in the whole wide world, MC Mo. We are back in our normal studio this week, so let's keep the routine going and get to a
Mo Money Market Update.
Lions, tigers, and bears, oh my! The market has been creeping lower, starting this week off with 3 straight down days until finally peaking its head just a couple points higher just this past Thursday on the close. Things are looking rough out there in the financial markets as there continues to be a lot of uncertainty and volatility. First, let's start off with the Federal Reserve, who seemed highly likely to raise rates this past Wednesday only a few weeks ago, left rates unchanged yet again. Rate hikes in July seem just as unlikely. Best chances in December if the economy decides it ever wants to improve. The economic data has been very weak lately, which led to the Fed's decision. Also, after hanging above $50 a barrel, oil has sank to just over $46 a barrel. The dollar has been heading downwards as well. The biggest uncertainty remains to be Brexit, concerned that Britain will leave the European Union and cause a financial chaos. The vote takes place next Thursday, and the market has been keeping a very close watch on these events. In other big financial news, Microsoft agreed to buy LinkedIn for $26 billion in hopes of expanding and improving its business cloud portfolio. It seems like a good move, but Microsoft has had a poor performance history with their acquisitions within the past decade. Now, from watching this show, you know there is one thing that I love more than anything: America. When you love America, it means you love freedom. If you love freedom, that means that you love capitalism. If you don't love freedom, you probably love socialism, and we all see how well that's working out for Venezuela right now, as their poor citizens are starving for food, and the lucky few who can get food have to be protected by the police so nobody tries to rob them. That doesn't sound like a country I want to live in. Now, when it comes to capitalism, there are 2 types of forces that can kill the freedom within the market: monopolies and the government. And when they work together, well, then capitalism does not stand a chance. But today we're going to be talking about monopolies, or specifically the laws the government has put in place in order to prevent them, and the goods and bads of monopolies. So let's go back in time to the mid-1800s, the dawn of the Industrial Revolution. People were moving from the farm to the cities, from out in the fields to into the factories. And just like that, America became one of the largest industrialized nations in the world. We produced steel, oil, and other goods, which raised many citizens of the great USA's standard of living. And it all happened so fast. Factories started springing up, businesses grew like wildflower, and there was a lot of people making a lot of money. And the USA and the government was loving it. Unfortunately, it was more of a party for some than it was for others. During the industrialized age, the United States government took a very hands-off, laissez-faire approach towards business. They didn't want to interfere too much in fear that they might ruin the economy. So businessmen were free to do what businessmen do, and that is make money. And they did. Some made a lot of money. This allowed some businesses to grow so profitable they started buying all the other smaller businesses or using other powers to crush smaller competitors in other ways. Thus was the age of large monopolies and trusts, which are organizations that have a majority to all market power over a particular sector of business. Now, with great power comes great responsibility, but too much power can be dangerous. And in 1890, the U.S. Congress passed the Sherman Antitrust Act. If we will not endure a king as a political power, we should not endure a king over the production, transportation, and sale of any necessities of life. This was a quote from Senator Sherman, who the act is named after. So I know all this legal stuff can get boring and kind of wordy, so let me just break it down for you and explain it in terms that you'll understand. Basically, Congress told the businesses that the party was over. No more monopolies, no more trust. They said if a business interferes or restricts commerce of another business in any way, boom, legal. So railroads could no longer charge insanely high prices to ship goods because one company owned all the lines. Companies could not engage in exclusive contracts. They couldn't give special pricing to one company or eliminate one company from doing business with another. This act is known as the competition law. That's the best way to explain it. If you have no competition, guess what? You're gonna get broken up. No competition is usually bad for consumers. It causes companies to get lazy, they don't innovate, they charge higher prices because they can, and it's just not good. Unfortunately, the first use of the Sherman Antitrust Act was used against a labor union. They said a labor union couldn't unionize because it created a labor monopoly. The first use of the act against a business was in 1904 against Northern Securities Company, a J.P. Morgan project to corner the railroad market by financing Great Northern Railway, which used Morgan's money to buy competing railways in hopes of cornering and creating a monopoly. The Supreme Court declared it a monopoly and it was disbanded. 1911 saw the breakup of John D. Rockefeller's Standard Oil and American Tobacco. Rockefeller's company had about an 80% share of the oil market before the breakup. So this seems all well and good, but some businesses felt targeted by the government, while others were able to slide by. The Sherman Act did not really go far enough to regulate monopolies, and it was full of loopholes that businesses were easily able to exploit with their huge teams of lawyers. Okay, so in response, in 1914, the Clayton Antitrust Act was signed, which basically built upon the Sherman Antitrust Act. First, the Clayton Act targeted holding companies, which were basically the new trust. Instead of owning companies outright, companies own shares of stocks in their competitors. The Act basically said if you're in control of company A and company B, and if they merge and cause monopoly, that's no longer allowed. It also created the Federal Trade Commission, the government organization created to prevent companies from engaging in illegal business practices. Famous exemption from the act was union laborers, which were allowed to protest and picket freely if it was peacefully and not face injunctions unless there was property damaged. So let's sum up that history lesson. Basically, if a business grows too big and uses manipulative practices such as collusion, dividing territory, refusal to deal, price fixing, and exclusive dealings, that's a monopoly, that's illegal, and now you're going to get broken up. It was made to ensure that capitalism could operate freely within certain restraints, and that competition would be ensured. Your mom and pop's business did not have to worry any longer about being crushed by a large competitor. One interesting exemption from these acts are natural monopolies and innocent monopolies. Natural monopolies are companies that have a large barrier to entry due to their high infrastructure costs. In this case, usually the government will take over the business to provide the services such as public utilities, water, and electricity. In this case, it would be called a government franchise. Amtrak is an example of this. The railroad company is owned and operated by the United States. Railroad travel started becoming unprofitable, so the traditional railroad companies started abandoning it. So the government stepped in and developed a company seeing railroad as a public good. AT&T is another example. In the early 1900s, they were granted monopoly over the phone industry. It was seen as a public good, and having too many phone lines running everywhere would be seen as inefficient and not good for consumers. Patents and copyrights are also other forms of government monopolies. Patents are seen as a fair way for inventors to have right to reap the reward for their inventions and be able to pay off the cost of production before others jump in with copycat products and bite into their market share. Innocent monopolies are companies that are just awesome and become a monopoly based on the fact that they're fucking awesome and everyone else sucks, and they don't engage in any manipulative practices to become that way. They just can't help it. They're like the Gretchen Wieners of corporations. Now, it's easy to point out the flaws of monopoly and why they should be legal. They corrupt the market, they kill competition, they charge higher prices, they don't innovate or improve their products or services. But there are a lot of good things to say about monopolies. I know that sounds shocking, but it's true. Take John D. Rockefeller's Standard Oil, one of the greatest monopolies of all time. Before Rockefeller, there were many competing oil companies, all looking to cut their costs to become more profitable in a very competitive industry. But when Rockefeller eventually began taking over and created a monopoly, he helped standardize the oil industry, created safer pipes, he had more money to create larger infrastructure, and had the money to pay scientists to find uses for the oil's waste, one of which was Vaseline. Monopolies have the economies of scales going for them, so since they're so large and there is enough demand for their product, they'll have the ability to produce more, thus lowering costs of their production, thus lowering costs for consumers. Research and development is much easier with large monopolies as they have more excess money to put towards innovating products and services, if they choose to do so. Some say monopolies self-regulate themselves. They don't keep innovating and improving the way that they did before they became a monopoly. This will eventually lead to their demise. Some people see monopolies as a survival of the fittest type situation. They see things like the Sherman and Clayton Antitrust Act as promoting inefficiency in the market. They believe this act hurts successful businesses while protecting the mediocre and detrimental companies, which is an interesting point, but the act does allow for innocent monopolies, so if this is the case, this should be a non-issue if you're truly that great. Bottom line, competition is what's best for the marketplace, but competition for the sake of having competition could be detrimental. Huh? Basically, the point is, if competitors are forced to lower prices and innovate to make money, this is good for consumers, an example of a good market. But if there are many competing firms who are providing lackluster products or services because they don't have the money to innovate and they can't raise prices because it'll make them uncompetitive, then it might be best for the market to have a little consolidation and allow some or one major company to take over in order to assure the best products, services at a reasonable price for the consumers. So as you can see, there are some shades of gray in the usually black and white argument of monopolies are bad. And that's what I wanted to show today. It's not the most important information to know as a young investor, but it's an interesting economic discussion. So next time you hear about the company accused of being a monopoly, whether it was Microsoft in the 90s, whether it's Google or Amazon today, instead of jumping to, well, they should be stopped, ask yourself, well, would it be more efficient if there are many competitors competing to provide this product or service? Or is it for the best that one company is taking on this responsibility, thus providing one standardized product or service? Thank you so much for watching another episode. You know we will be here every week with a new episode of Mo Money. For now, don't forget to like, comment, subscribe, and share this video with all your friends. Follow me on Twitter and Instagram. Like me on Facebook. Mo Money.
Signing now.